Did you know that 90% of millionaires built their wealth by investing in real estate? Imagine turning a simple apartment into a steady monthly income stream that hits your account while you sleep. If you're aiming for financial freedom, this video could be a turning point. Like, comment, share, and subscribe to master the real estate investment game and change your reality. Why invest in real estate? Real estate is one of the most solid and time-tested ways to build long-term wealth. Unlike stocks or cryptocurrencies, real estate is a physical asset. You can see it, touch it, and improve it. That gives investors a unique sense of security, especially in uncertain times. Plus, real estate is practically immune to tech disruption or replacement by artificial intelligence. You're never going to see a piece of software living in an apartment, right? Housing demand is constant, and it grows with population increase. Another major advantage is passive cash flow from rental income. Receiving monthly payment from tenants helps you build a predictable income stream. That cash flow can cover living expenses, fund new investments, or speed up your retirement. Real estate also offers highly attractive tax advantages. You can use legal strategies to reduce or even defer taxes on your profits. That's something you rarely see in the stock market, where profits are taxed immediately upon sale. Its history of appreciation is another strong argument. Entire neighborhoods in cities like Austin, Berlin, or Lisbon have doubled in value over the past decade. Well-chosen properties in strategic areas tend to increase in value over time. Compared to stocks, real estate stands out with its tax flexibility. While selling stocks triggers immediate taxes, real estate allows for strategies like depreciation and the 1031 exchange. That means more control, more returns, and fewer tax headaches. Challenges and realities of real estate investing. Let's be honest, investing in real estate isn't a fairy tale. It takes research, commitment, and upfront capital, often a significant amount. The idea that you can start with no money down is risky and usually unrealistic. Many of the so-called no money down strategies are complex, high risk, and not suited for beginners. Starting this way can quickly lead to costly and discouraging mistakes. Early mistakes are common and painful. It might be a poor location choice, a miscalculation, or a renovation that goes over budget. But those early stumbles come with lessons that stay with you. Just like learning to ride a bike involves falling, real estate investing has a learning curve. The key is not giving up after the first setbacks. Those who stick with it build wealth and eventually master the game. Core elements to start with. Before you buy your first property, you need to master 3 fundamental pillars: location, team, and numbers. Neglecting any of these can turn a good deal into a nightmare. Location is the most important factor. A mediocre property in a great location can still perform, but a beautiful property in a declining area will always be a financial burden. You'll also need a trusted team. Real estate is a team sport. You'll rely on experts. Without that support network, your risk increases and mistakes become more likely. Finally, you need to understand the numbers. You must know how to calculate return, expenses, fees, and cash flow. If you don't know the numbers, you end up buying emotions, not investments. How to choose a good location. Picking the right location is half the battle. Cities like Charlotte, Dublin, and Toronto have grown fast thanks to incoming businesses and people. Study the region's economic and commercial growth indicators. You need to know where money and people are moving. Some up-and-coming neighborhoods are still affordable but have massive potential. Meanwhile, saturated areas are expensive and offer low returns. Analyze different zones carefully. Not every central neighborhood is ideal for rentals. Sometimes, a suburb with good transportation access gives a much higher ROI. Use the $5 coffee test. Go to the area, visit a local coffee shop, and talk to residents. Ask about safety, value appreciation, and future developments. That direct contact reveals more than any online research. Visit City Hall or the official city website to learn about development plans. Upcoming subway lines, parks, shopping centers all signal future growth. Smart investors keep an eye on city planning. Finally, look at population growth. If more people are moving in, demand for housing increases. And where there's demand, there's profit potential. Building the ideal real estate team. Real estate investing isn't a solo sport. It's a team game. Even if you're the one funding it, you'll need experts by your side. Each one plays a key role in protecting your investment. Your team should include an experienced real estate agent, a specialized accountant, a licensed contractor, a property inspector, and a reliable property manager. With the right team, you'll be equipped to make confident decisions. But remember, hiring them is just a start. You need to constantly evaluate your team's performance. If someone isn't delivering results, don't hesitate to make changes. Your money's on the line. Key roles in your real estate team: real estate agent. A good agent makes a huge difference. Look for full-time professionals with a proven track record in your target area. Avoid part-timers or agents without experience in investment properties. Great agents have access to off-market deals, the ones not publicly listed. These usually come at better prices and face less competition. They're also skilled negotiators, which can save you thousands. Never sign exclusive contracts with agents who don't deliver. Be clear. You want results, not promises. Work with those who perform. Specialized accountant. The accountant is your tax strategist. They apply techniques like depreciation, loss offsetting, and the 1031 exchange. This legally lowers your taxes and boosts your net return. Depreciation, for example, lets you deduct property value over time. Losses can offset taxes from other income sources like salaries or business profits. And the 1031 exchange defers taxes when swapping one property for another. Tax mistakes are expensive. Choose an accountant who knows the real estate world inside and out. It'll save you from future financial surprises. Other professionals. The inspector checks the property's structure before you buy. They spot hidden issues that could become costly problems. Never skip this step. It protects your investment. The contractor handles renovations, upgrades, and repairs. A skilled, honest contractor can turn an average property into a rental goldmine. Choose wisely and ask for solid references. The property manager handles the day-to-day, rent collection, maintenance, and tenant communication. They're your right-hand person in managing the rental. With a good manager, your investment truly becomes passive. Tax benefits of real estate investing: depreciation. Depreciation is one of real estate's biggest tax perks. Even if your property is rising in value, on paper you can claim it's losing value. This lowers your taxable income and reduces your taxes. There's also accelerated depreciation, bigger deductions in the first years. Perfect for investors wanting quicker returns. Loss offsetting. If you lose money on a property, you can use that loss to reduce taxes on other income, like salaries, stock profits, or business income. It's a legal, strategic way to manage your tax bill. You can even carry those losses forward to future years, giving you flexibility. Very few investments offer this kind of advantage. 1031 exchange. The famous 1031 exchange lets you sell one property and reinvest the proceeds in another without paying capital gains tax, as long as you follow specific rules. Hold the property for at least a year and reinvest the full amount. You can repeat this process indefinitely, even until death. Many investors build wealth using this strategy for decades. And since the taxes are deferred, not eliminated, you keep more capital to reinvest. It's a smart, widely used growth strategy. How to analyze a property financially. NOI, net operating income. NOI is the foundation of every analysis. Here's the formula. Monthly gross income minus all operating expenses. For example, if the rent is $2,000 and costs are $1,050, your NOI is $950 per month or $11,400 per year. This number shows the property's true operating profit. It's essential for calculating return and assessing if the deal is worth it. Without it, your analysis is shallow. Cap rate. Cap rate is the annual return based on the property's price. Formula: annual NOI divided by property value. In this case, $11,400 divided by $200,000 equals 5.7%. Every investor has their target cap rate. Some are okay with 4% in prime areas. Others aim for 7% or more in emerging markets. Impact of financing. Financing can eat into your profits. An 80% mortgage might result in negative cash flow. If that happens, You have three options: increase your down payment, negotiate a better deal, or raise the rent. Be careful not to finance a bad investment. The cost of money must make sense in the deal. Run your numbers clearly. Real estate investing is one of the most reliable paths to passive income and financial freedom. But as you've seen, it requires knowledge, strategy, and deliberate action. With the right know-how, the right team, and smart decisions, you can turn property into a lifelong income-generating asset. Enjoyed this content? Then like, comment, share, and subscribe for more practical, high-value tips. Let's build your financial independence, brick by brick.